Bob, I want to start with you, and really, people just want to know what really is bothering markets right now.
Listen, it's been kind of carnage in rates, and Romain, I remember, being on Wall Street Week with the team in January, and I think Afsana, you were on the same session, and we talked about if the Fed, did not begin raising rates soon, if they did not begin going from super easy to neutral, then they were going to have to raise rates further than anticipated. And I think today, overnight Fed funds rates are still at 0.33 of 1%. But you can see in the 2-year and the 10-year and the future forwards for Fed funds rates that rates going forward are going to be raised probably more than we had anticipated just a few months ago. And certainly for growth stocks, that's really tough to take. And we're seeing it, the big impact in the NASDAQ and tech stocks. And I think that's unsurprising given the speed of the rate increases that we've had.
Afsana, does that change the macroeconomic picture, though, for investors?
What it changes is that I think at the moment, everyone is assuming that inflation will continue the way it is. And somehow, for some reason, psychological or otherwise, today really hit investors in a much bigger way, Romain, than before. So the Fed has been talking about starting to increase interest rates now for a little while. As Bob said, obviously, maybe it should have started a long time earlier. But the main thing is somehow today they realize that supply chain issues are going on. The war is going to be a bigger problem, and interest rates are going to go up. The big question I have is whether in practice, interest rates may not have to go up as much as we're assuming right now, because we are seeing that the market is reacting to what is being put out there now as news. And if that happens, maybe inflation will start coming down a little bit earlier. And we are seeing at the same time that inventories have been built out. Consumption is starting to get a little weaker. And the signs are that things could potentially soften a little bit.
Well, we've certainly seen financial conditions come down quite a bit here, and maybe that could make the Fed's job easier, Afsana. I am curious as to what you made out of that GDP report that we got this week that showed a contraction of 1.4%.
I think GDP numbers, as we very well know, are generally not super reliable, and they do get adjusted. So on the one hand, if we look very closely, what was really interesting is the fact that imports went up as much as they did, but exports did not. And obviously, with the dollar having been stronger, with the supply chains that we've had, that's not a very big surprise. The area that was really, I think, important, and the GDP really did not get into it, is the fact that the lowest income population in the US still is worse off. And therefore, if that's the case, that will have a much bigger impact on GDP moving forward, because that's the group that will consume more, and their consumption is much more sensitive to what's going on in the economy.
And Bob, when we look at the economic data out there, that GDP report notwithstanding here, you're still seeing relatively strong consumer spending. You have a job market that most people seem to think is still relatively healthy here. Do you think that the economy, is on solid footing, and can it withstand an aggressive Fed?
Listen, I think the numbers were a little bit misleading to what Afsana said. GDP is about output, not demand. And, in the fourth quarter last year, it was up 6.9% and down 1.4. But 5.3 of that 6.9 was the buildup of inventories. So if you strip out that big inventory, you can actually look, as Afsana said, domestic demand actually improved. Consumer spending was stronger in the quarter. So on the one hand, we still face the same challenges, which is core inflation's at 5%, well above target. The labor markets are too tight. There are 11 million job openings, Roman, and there are 5 or 6 million unemployed. We've never seen a gap that big since we've been, recording these kinds of numbers. So I do think that the Fed has a lot of work ahead of it. I do think it's a very important meeting coming up. Because as I said earlier, we still have rates at 0.33 of 1%. And we need to begin going from super easy to something that's more normal.
If you had a seat at the table at that Fed meeting next week, what would you advocate for? 25 basis points or something more?
I think they're going to raise 50 basis points. I think if you asked me, I'd say 75. I think they've waited too long. And by the way, the Fed and the Treasury played a blinder in March of 2020. What they did, with the onset of the pandemic was extraordinary. But they waited too long to begin getting back to normalized rates and a normalized curve. This is what we talked about in January, after the economy was fully recovered, after we already had, constraints in the labor market, and after we already had price stability above the kind of targets that they had set. So I think they just waited too long. Therefore, they really need to get ahead of the game. And I would love to see them do 75 to 100 now. I don't think they will. I think they'll do 50.
So, Afsaneh, do you think that it's possible, I guess, for the Fed to effectively catch up with maybe what some people already view as a mistake?
I agree with Bob, by the way, that they will do 50 basis points. I think the important point is the psychology of the markets, right? So what I said earlier, I still believe that if the Fed is starting to talk about 50 basis points, if the market starts talking, which it has already, about 75 basis points, that in itself is going to impact markets and impact inflation and demand. And also, let's not forget, mortgage rates, 5% plus, right? Housing prices, 35% more. They're going to be dampening of demand as we move forward with these kind of prices. And, another part of the economy that we should really look at is as people have acquired goods, then started using services as COVID allowed us to go out of our houses and people are traveling. Once you've sort of caught up with some of these changes in life, demand may not be on the same slope as everybody's expecting it. In that good scenario, we might catch up with inflation better, if I want to be positive.
Well, let's look at real quickly here the earnings season, Afsaneh, that we're almost halfway through here. We've gotten some of the big names out there. Have you been relatively encouraged by what you've heard, not just with regards to the numbers themselves, but also the commentary out of some of the executives?
You're absolutely right. Expectations were more positive than we expected. And a lot of the numbers came, 77% of numbers were better than we expected. On the other hand, I think, again, the dampening effect is if the underlying consumption will start to weaken, if we assume that as rates go up, and again, the behavioral part of the impact of the rates going up, start impacting companies. You're hearing a lot of CEOs looking forward, the guidance they're giving, whether it's Meta, whether it is JP Morgan, whether it is other company CEOs, all getting us to worry more about what's ahead earlier in the rest of the year.